In today's episode, I'm going to walk you through what it means when trading is suspended and you are unable to buy or sell shares of a stock. This happened today on GameStop, it happened on AMC, and in fact, it happened on a number of different stocks. And I saw traders expressing frustration. They were saying, I don't get what's going on. I own shares of GameStop and I want to sell and take some profit, and I can't. My broker's not letting me. Or some people are saying, I want to buy shares of AMC and I can't get in. What is going on? Is it the exchanges? Is it the broker? This doesn't feel fair. It doesn't feel right. This is all the result of a misunderstanding about a little mechanism in the market that was originally designed to prevent flash crashes. So let me walk you through this by beginning with a description of what a flash crash is. A flash crash is when the stock price suddenly begins dropping and then it accelerates faster and faster and faster and faster until it finally bottoms out. But a lot of times it ends up bouncing right back up. These flash crashes are made bigger by high frequency trading algorithms and by stop orders. People often will put out a stop order. They say, this is my max loss on a trade. But as you know, if the price declines to that, the order will go through as a marketable order. Then the price is going to drop more because it's a sell order. And then it might take out another stop, which then triggers another sell order, which then triggers another and another and another. And suddenly the high frequency trading algorithms can send a stock down 30, 40, 50% in a matter of minutes. And it's happened before. So circuit breaker halts, also called trading pauses or trading suspensions, are a mechanism where if a stock drops more than a certain amount within an average of 5 minutes, trading will be paused for a period of 5 minutes. This gives the high frequency trading algorithms a moment to just turn off because they can't run. It gives traders and investors a moment to kind of catch their bearings and decide what's going on. And it slows down the volatility of the market. So this is what was happening today on GameStop. So if I pull up the chart, what we'll see is that this is a stock that made a really big move. In fact, it went from yesterday about $29 a share all the way up this morning. It hit a high of $80 a share. And you know what? During this whole period right here, it didn't halt even once. So what was going on there? Well, these trading suspensions, these halts, only work between the hours of 9:30 a.m. and 4 p.m. Eastern. Those are regular trading hours. This is when halts take place. This is also when stop orders are working. So if you recall, from 4 a.m., the open, until 9:30 a.m., there are no stop orders and there are no trading halts. And from 4 p.m. until 8 p.m., there are also no halts and no stop orders. So during the hours of 4 a.m. to 9:30 a.m., when GameStop was squeezing up, there was no risk here that it would be halted on one of these volatility pauses because they don't occur pre-market and they don't occur after hours. They only occur during regular trading hours. Now, these volatility bands, it's what we call them, a volatility band, they exist on every stock and they even exist on indices at large, like the S&P 500. But there are different thresholds for different types of stocks before it'll trigger a actual trading pause, suspension, or halt, whichever term you prefer to use. So on lower price stocks, the thresholds are bigger. In fact, if you have a stock that is less than 75 cents, the pause is every 15 cents. So if you have a stock that's priced at 50 cents a share and it goes up 15 cents, it'll halt and it'll be paused for 5 minutes. Now, a stock between 75 cents and $3 a share, it's every 20%. And a stock $3 and up is every 10%. So GameStop fell into the category of being, of course, above $3. Therefore, every 10% it'll halt. But the way it's calculated is by the average price over the last 5 minutes. So what it's actually looking at here is not 10% away from the current price, but 10% away from the average price. So I'm going to make this chart full screen so you can kind of better understand the way this works. Let's zoom back here to the open. Okay, so in this area right here, at any given time, we have volatility bands once the market opens. They are about 10% above the current price and about 10% below the current price, roughly. So the average price is the average of these last 5 candles. That creates your average. And so the average price of a stock is constantly moving. It's constantly adjusting. So it updates approximately every 30 seconds. And so what we see on a stock when we're actually watching it, if you're looking at the level 2, and we can look at the level 2 on GameStop here, this is the depth of market. And what this is going to show us is our current volatility bands. So let me make this a little bit bigger. Oops, sorry. So our current volatility band down on GameStop is 49.03, that red quote. And the one up is, oh, it's far away. It's way down at, way up at 54.19. And it's labeled with LULD, limit up, limit down. So you see right now that limit up, limit down is currently at 49.03. And as the price is declining, the current price is actually a little closer to the halt down level than the halt up level. So if this stock drops to 49.03, it cannot go lower. It'll drop to 49.03, it'll sit there. And if it stays at that price for 15 seconds, then the stock will be halted for a period of no less than 5 minutes. There's no trading for 5 minutes. If you want to sell, you cannot sell. You have to wait. The high frequency trading algorithms can't sell either. Everybody just has to wait. So you sit and you wait. If it halts up, same thing. So what happened at the open, and this was predictable, there were a lot of people that were holding GameStop from the previous day. And those are people that didn't know how to execute trades pre-market. So they didn't sell pre-market. Some of the people holding might have been at work. You know, they'd already gone to work, but they had an order to take profit. And maybe it was a sell order at $45 a share down here. Now, if that order goes through, the second the market opens, all of a sudden there's a lot of people selling. And so all of those sellers forced the stock down. And it dropped so quickly that the stock halted going down. It halted for a period of 5 minutes. So there was no trading. And during this time, people were not understanding, why can't I trade? I can't get in, I can't get out, I'm stuck. And it's because of a circuit breaker halt due to the stock dropping more than 10%. I expected this to happen. This did not surprise me at all. It then resumed trading 5 minutes later, and it halted down a second time. There were more people that wanted to sell. And then you know what I did? I bought it down here at about $47 a share. We had the resumption, and then the price stabilized. And as it began to move back up, I got in, and we got this nice squeeze back up to 56. Because I understand the mechanism of circuit breaker halts, I understand how they work, I was able to position myself so I did not get caught in a circuit breaker halt as it was going down. I waited until all the selling subsided, and then it came back up. And as it came back up, it actually halted once and then twice going back up, because it bounced up 10% off the low and it halted. And then it bounced up another 10% and it halted a second time. So there are times where we see stocks that halt back to back to back to back. Just a couple weeks ago, we had this stock BENF, which I'll just show you as an example. This stock had many trading halts. It's going to take a second for the charts to load. We've got to go back a little ways. So these were the halts back in here. This stock went from $1.50 all the way up to $13 a share, as you can see here. But it halted many times. So if we look at this chart, the first halt was, let's see, I think it was right down in this area. So this was 44, 43, 45. So nope, sorry. The first halt, it went up, squeezed up here. And because in this area, the move was not so fast that it halted. Let's see, the first halt was right here. We halted for 5 minutes, and then it pushed higher, but it didn't quite hit the halt level. So remember, those thresholds are constantly moving. That's the halt up, that's the halt down. So in this case, it came up and it halted right here. It then resumed and went into another halt. So now this was the third halt of the day. This is the fourth halt of the day. This is the fifth halt of the day. This was the sixth halt, and it was halted down. Then it halted back up again. So then it halted back down. You know, these are very, very volatile. So what's happening here are what we call circuit breaker halts. If a stock goes up more than 10% in less than 5 minutes, it can get halted. The halt time is generally for 5 minutes. However, they can halt it for longer. And the reason they would halt it for longer is because during the halt, people will sometimes put out orders to buy and sell. And now those orders have to get matched in order for the price to resume. So if there's a really large imbalance between all the buyers and the sellers, then the stock can remain halted. And we've seen stocks that have been halted for 10, 15, 20 minutes, 30 minutes, an hour, even longer, because there was such a big imbalance between buyers and sellers. So although there are some strategies for trading around halts, getting in and then being in for a halt going up, you have to be very cautious, because when you're in a stock that's halted, you cannot buy, you cannot sell. All you can do is wait. So for traders who understand how these halts work, you could trade around them. You can make money by being in a stock that's halted and then seeing it gap up. And you can avoid being at risk of getting caught in a position where a stock is dropping, it's halted down, and then it resumes lower and then halts down second time. Because when that happens, you can feel stuck, and you are stuck. But I want you to understand that this is not something that the brokers are doing willy-nilly. They're not just pressing a halt button to stop trading. These halts happen at the exchange level, and it's part of a regulation that's designed to prevent flash crashes. Now, in 2021, when Robinhood took away the buy button, that was different. That was completely different, and I don't think that was okay. I don't think that was fair. That was something that they chose to do because of, they came up with all these reasons why they did it, but I don't think that was fair. Now, other traders talk about brokers taking away margin. This is also very common, and this happens pretty much every day. In fact, if we look at GameStop today, we can look at the broker that I'm using here. This broker is not allowing me to use any leverage or margin on the stock. It shows 100% right here, which means I have to use 100% of my cash to trade it. If we look at TSLA, you'll see I can use 40% cash, 60% leverage. If we look at Ford Motor Company, I can use 25% cash, 75% leverage. So I can trade on borrowed money. It is the broker's discretion to limit your ability to trade on borrowed money. They'll let you do it on Bank of America. They'll let you do it on Ford. They're going to pull back a little bit on Tesla. They're going to pull back even more on a stock like GameStop. Because when you're trading on leverage, you're trading on borrowed money. And if you lose that, you're now in debt to your broker. And if the broker is concerned about having a ton of traders go into the negative, trying to short GameStop or something like that, then they may just make it impossible for that to happen. And that is within their discretion to make those restrictions. So they're allowed to do that, but they have no ability to change or enforce the circuit breaker halts that occur here. These come straight from the exchange as part of the regulation. So there's nothing they can do with that. And these are going to happen all the time. In fact, today, we probably had on GameStop 7 or 8 halts today. We'll probably have more before the end of the day. We had a bunch of halts on AMC. This stock, which is up 200%, had a bunch of halts. This one, we have halts all the time. As an active trader, I'm accustomed to them. It's no surprise for me. But when I see traders on social media complaining and they're frustrated, that's what makes me want to put out this episode, because for you, this financial literacy will empower you to be a better trader. You've got to keep learning. So I hope you found this episode helpful. I hope you hit the thumbs up. I hope you subscribe to the channel. I'll remind you, as always, that trading is risky. You may have noticed here that I was up $21,000 this morning. These results are not typical. There's no guarantee you'll find success. Whether you trade with me or you learn on your own. So the best thing you could do as an aspiring trader is manage your risk and practice, as always, in a simulator so you can learn about these things in the market, circuit breaker halts, how level 2 works, everything else, in a safe environment. All right, the market's going to be here for you. It's not going anywhere. And I guarantee this is not going to be the last time we see a stock that goes up 50, 60% in one day. This is the way the market is. We keep seeing these moves. So study up, and I'll see you for the next episode real soon.